Hi, my name is Liz Thompson, and this is a video for IME 315, Financial Decision Making for Engineers at Cal Poly San Luis Obispo. This particular video is on the calculation of take-home pay. So when we look at the 5 areas in this class that we're covering, this particular video falls under personal financial decisions. So what I'm going to do today is talk about your take-home pay, which will be your salary less all the deductions. If you've ever gotten paid with a paycheck, you will remember that there's a lot of things that get taken out of your salary in order to get to your take-home pay. And we'll go ahead and calculate this for a typical engineer. The first things we want to talk about are going to be federal income tax. And this is federal taxes. The first is income tax, and then the second Social Security tax, and the third is Medicare. There's also state taxes. So in this case, we have income tax also for the state and disability insurance. And I'm going to talk about the state that I'm going to consider is California, and we're going to talk about the California deductions. So both income tax for federal and state purposes are what we called a progressive income tax system, and I'll go over what that means. This is as opposed to a flat tax where everybody gets taxed the same amount. Progressive means the more you make, the more that you will be taxed. Medicare is always 1.45%, and that's paid by both the employer and the employee. So you will see this deduction on your out of your paycheck. The same is true for Social Security, except for the rate is 6.2%, and there's a limit of $113,700. And this tax is paid by both the employer and the employee. State disability insurance is 1.2% on the first $93,000 of income tax. So we'll go ahead and calculate all of these. First of all, let's look at the individual income tax. So this is the tax rates for 2019. And if you see this, what it shows is that at the lowest rate, at the lowest level, when taxable income is between 0 and 9,700, you're taxed at 10%. But then at the next level, between 9701 and 39,475, you're taxed at 12%. And you can see that when you make more than $510,000, you're actually on that amount over $510,000, you're taxed at 37%. So if we graph it, it looks something like this. It's a step function. So at the lower rates, you're only taxed at about 10%. But then as you progress up, the income tax rate increases. And it's important to know this is marginal tax rate. So for everybody on the first 9,700, they're taxed at 10%. And at the difference between 97 and 39,475, they're taxed at 12%. But as we get more and more, the marginal tax increases. So this is the same for, also this is incremental. And the other thing is to notice that we're talking about taxable income, and there's deductions from income are allowed. And one of the major ones that we often get to deduct is either a standard deduction, which is about $12,000, or is a like things like the interest you pay on your mortgage or charitable contributions. Those are also deductible for calculations of taxable income. So let's look at state income tax is the same way. It's progressive. So you can see at the lowest level, it's 1%. And then it goes all the way up. If you make over $1 million in California, it's at 13%. So let's look at this calculation. So just let's say our income is $25,000. So we can see that for the first 8,223, we're taxed at 1%. And then for the difference between 19,495 and 8,223, we're taxed at 2%. And then the difference between 25,000, which is the amount that you have, minus 19,495, you're taxed at 3%. So if we do that calculation, it means that for somebody who's making has taxable income of $25,000, the taxes they pay are $472.82. And that's how that calculation works. So let's look at an example. So for federal and state income taxes, the wages can be reduced by qualifying deductions. For instance, dependents, charitable contribution, and interest on primary residence are often deductions. So for our example, we're going to assume there's going to be $10,000 of deductions. So let's say we have a $65,000 income and we have $10,000 of deductions. So that means that our taxable income is $55,000. So then if we do the calculations based on the incremental tax tables previously that I showed you previously for federal, that means we're going to be paying $7,958. For state, I do the same thing, and the taxes that we pay are $46.94. So you can see we have $65,000 income, and we have to pay taxes of about $7,900, and then for federal, and then about $4,700 for state. Other deductions that we have to take are Social Security, Medicare, and state disability insurance. These this is not calculated based on taxable income. It's calculated based on the wages that you earn. So there's no deductions for these taxes. So it's 6.2% for FICA or Social Security. It's 1.45% for Medicare, and it's 1.2% for state disability insurance. So that if we look at that, that means we have $65,000 of income. We had to pay federal tax, we had to pay Social Security and Medicare. Those three are federal taxes. And then on the state side, we had to pay state income tax and state disability insurance. So of the $65,000, we ended up getting $46,000 income. We have other deductions. And so in this case, I'm assuming that we have health insurance of $500 a month that we have to pay. We have retirement contributions of $500 a month. So those are both $6,000 a year. And then we have other, whether it's parking or health, other kind of vision insurance or anything else, life insurance that we might include. So that means our take home is now $33,000. So if we do the calculations, pre-tax at $65,000 was $54,17, but take home is $27,83, which is quite a bit different. So you need to remember that when you're thinking about your own budget, when you are actually become a salaried individual. So this particular video covered personal financial decisions.